The Russell 2000 saw its biggest sell-off since 2020 following the Fed's hawkish pivot. But could small caps be a safe haven strategy to play? Joining us now is Dana D'Orio, who is the Envestnet Solutions Co-Chief Investment Officer. Dana, great to have you back on the program with us. So let's just start with that question. Could small caps be a safe haven amid some of the volatility here?
Well, I think it's always important to talk about this in terms of the time frame that you're thinking about, right? So, I mean, small caps are, you have to be thinking very short term to be thinking, small caps in the short run could or could not be a safe haven. I think small caps are obviously more volatile, generally speaking. Now, over the long haul, they have tended to pay off for investors. Particularly when you remove the growthiest small cap stocks, which are sort of lotto ticket type payoff. So I very much support small caps over the long haul. I think when you're thinking in terms of cyclicality and where you want to sit right now, if you're concerned about potential volatility, small caps are a tough play because of course they're more interest rate sensitive. Obviously, so the prospect of higher for longer was very bad for small caps in the short run, and risk off in general hurts small caps. So safe haven, I wouldn't look at them that way, but long-term value creation, yes.
So Dana, I guess for investors that are looking for that safe haven exposure, right? They do still want to stay invested. They're a little bit worried about, clearly there is some reflection of that played out in the markets yesterday. Where is that? Is that tech still, or I guess how should they then be balancing some of that risk?
It's a great question because I think obviously in the last several years, tech has kind of become synonymous with defensive, right? It's that, when there was trouble in the market, we see tech kind of do well, because these are huge names, very well capitalized, not reliant on capital markets in any way for funding. And so, you see money kind of flow over to these names, of course. But we also exist in a place where we have obviously a very high level of concentration in the indexes. And most people, if they're not actually market cap weighted, index tracking, they're in some sort of active portfolio that has to be at least benchmark conscious, right? And so tracking error is a consideration. And if you're sitting there, it's really hard to be very far from big tech. So I think plowing even more money into big tech, kind of exacerbates that concentration issue for you. If, the traditional place to sort of sit in the markets, if you want a little bit of padding, is something more like defensive, true defensive, which would be quality indicators, right? And or low volatility indicators. So quality on the fundamental side and low vol, minimum variance on the technical side are places that you can sit.
How can investors identify quality names when you do have high volatility like we're seeing play out right now?
Yeah, easy ways to get in is, you have quality ETFs and mutual funds and plays that'll filter around quality indicators like, accruals, like high profitability. Really the research tells us that profitability, not bottom line profitability, but a little bit higher up on the income statement is a pretty good indicator of quality. It tends to pay off over time. Not only is it a place where you sort of have this asymmetric benefit that you can kind of hang out in these stocks, and it's not to say they won't suffer, right? Nothing is for sure, but it tends to be the case that there's an asymmetric benefit to reducing volatility, being in quality type indicators, and yet you don't lose as much return as you would expect you would. And then over time, these quality types of stocks do pay off if you sit with it long enough. But again, there's two sort of ways of looking at that. One is fundamental indicators like profitability. The other is looking at just what is the performance of the stock, how volatile is that stock, how much of a contributor to volatility is it to the overall index.
Dana, when we talk about volatility, we certainly have seen this risk on sentiment with the obviously exclusion of yesterday and some of the one-off days, but we have seen this march higher. And what's been remarkable to us and what we have talked about so many times here at Yahoo, especially over the last 5 weeks or so, is the move to the upside in Bitcoin. And I bring that up because you mentioned that in your notes, some of the opportunity that you are seeing investment-wise. I guess my question is, how much exposure should investors be looking for at this point to crypto, and what makes the most sense as they are trying to balance some of that uncertainty?
Yeah, I think it's it's a beauty in the eye of the beholder, I guess, right? We don't have a particular statement that you should be in crypto or not be in crypto, but we are seeing more use of crypto now that you have the SEC has approved these ETFs. Obviously, you have big name asset managers with a crypto ETF out there that the investor is able to invest in. and get the return on crypto without having to worry about cold storage, wallets, and all the operational concerns that they might have to by owning the actual Bitcoin. So I think that, of course, opened up a whole new investor base. The fact that you have these ETFs available, we're seeing obviously money on the Envestnet platform going to these ETFs. It's relatively low at this point, but just the fact that the advisory community now oversees money in crypto, I think tells you something about how it's changed over time in terms of its investment potential. And I also think investors, to a certain extent, like the lotto payoffs that crypto potentially offers, right? There's sort of an asymmetric benefit there, especially when you see what crypto has done over the last, last month or so, right? Is there's this massive potential lotto payoff. And, even a typically risk-averse investor, having a little slug of that 1% or whatever, they might actually appreciate in the portfolio. So it doesn't mean it's not incredibly volatile. Even at a small amount, it will raise the volatility of that overall portfolio. You have to bear that in mind.